You may have a lot of different places that your retirement income comes from. You might have a pension, you might have Social Security, annuity income. So in today's video, we are going to talk about how 10 of the most common retirement incomes get taxed.
Now we're going to talk about just the federal tax, Amber, because every state is different. We're going to talk about pensions and Social Security. Some states tax pension income, some don't. Some states tax Social Security income, some don't. So we're just going to cover the federal regulations for retirement income here today.
Okay, so the first thing we want to talk about is one of the very most common retirement incomes, and that is income from your traditional IRA or 401k or TSP if you're a government employee.
That's right. Anything from a traditional tax-deferred account like the 401k, IRA, or TSP will be taxed as ordinary income, just as though you received it on a W-2 wage. Because really, Amber, that's all it is, right? In 2021, if you defer $10,000 of your wages to your 401k plan, when you take it out in the future, it's just income you earn. So it's fully taxed as ordinary income tax rates. Those rates go from 0 to 37% on the federal side, depending on your total income.
And eventually you are going to be required to take this money out.
At age 72. And we should mention, Amber, if you are under age 59 and a half and you are pulling money from those traditional retirement accounts, you may incur an additional 10% early withdrawal penalty on top of the ordinary income tax rate. So that's really designed for once you retire after 59 and a half.
So just retirement income. Okay, so the second thing we want to talk about is Roth IRAs, Roth TSPs, Roth 401ks. And that's actually taxed differently than the traditional IRA.
100% differently. It is tax-free if done properly. So in order to be tax-free income from a Roth account, it has to be there at least 5 years, and you have to be, again, at least age 59 and a half before you start pulling money out. But whether it's a 401k, IRA, or TSP, if they are Roth accounts, they will be tax-free in retirement.
And this is because you already paid the tax on the money going in, of course, and so your gains are growing tax-free.
Right, so going back to our 401k example where you deferred money to that, this is not. You got the money, you paid the tax to Uncle Sam, and now you're letting it grow, and he's letting it grow tax-free after that.
So the next thing we want to talk about is Social Security. Now this actually applies to most retirees today.
Right. This is the big one. We could do a whole video about Social Security taxation. It depends on whether you're married or single and what your income level. Essentially, between 0% of your Social Security benefit and as high as 85% of your benefit is taxed. Now that's based on your provisional income and your marital status. So if your provisional income on a married return, joint return, is $32,000 or less, your benefits are tax-free. But if they're between $32,000 and $44,000 for joint filers, half of your Social Security benefits are taxable. If your provisional income is greater than $44,000, then up to 85% of your benefits are taxable.
So to determine your provisional income, take your modified adjusted gross income, add half of your Social Security benefits, and add all of your tax-exempt interest to that.
So those are the parameters, right, for provisional income. So it really only applies to taxation of your Social Security benefits. But they are taxable for most people.
Okay, so let's move on to pensions. Now this actually is applying to fewer and fewer people nowadays.
Yeah, mostly government employees. Very few private sectors still have them. But the pension is a guaranteed lifetime income payout, which we love, right? We love that. Pensions, just like a traditional 401k or IRA, are going to be taxable as ordinary income. Just like they're paying you a paycheck, now they're just keeping it going in retirement.
And again, some states treat pensions differently, so that varies from place to place.
Correct.
Okay, so moving on to stocks, bonds, and mutual funds. Now, again, that's taxed differently than other retirement incomes.
Now, we're talking about, Amber, stocks, bonds, mutual funds just held in a brokerage account, a taxable brokerage account. Most often, if you're married, this is owned jointly with your spouse. That's how we know it doesn't get any special tax treatment. But Gains in stocks and bonds and mutual funds receive a capital gains tax treatment. So if you buy a stock at $100 and it goes to $150, that $50 gain is taxed at capital gains tax rates, which are far lower than ordinary income. The tax brackets for capital gains are 0, 15, and 20% if you've owned that stock, bond, or mutual fund for more than 1 year.
So just to clarify, what happens for people who own these stock accounts in a traditional or Roth IRA?
Great question, Amber. So let's say you own ABC Mutual Fund in your 401k. When you sell that and take it in retirement, fully taxable. You can own the same exact ABC Mutual Fund in a joint brokerage account and get the capital gains tax treatment. So we have to determine what kind of wrapper that account is in. And if it's in a 401k wrapper, it's taxable. If it's in a Roth IRA wrapper or garage, not taxable. If it's just owned as an individual or with a spouse, then it is taxable at capital gain tax rates, and that's the difference.
Okay, so that's something important you need to know, and make sure you check with your financial advisor about that. The next thing we want to talk about is annuities. Now, this is a big one for our clients because we really highly recommend income annuities for lifetime income for our clients. So let's talk about how those are taxed.
Amber, we want to talk specifically about non-qualified annuities or annuities purchased with after-tax dollars. For example, say an individual purchases an annuity with $100,000. Over the years, that grows to $180,000. When the income comes to that individual in retirement, only the interest is taxable. So in our example, if you've got $100,000 is their basis, there's $80,000 of interest. The interest will be taxable, and how it's taxed depends on how the money comes out of the annuity. If it's over your lifetime or over a period of 10 years or 20 years, then we get to stretch the tax bill on the $80,000 over that same amount of time. If you're taking it out just big chunks at a time, $20,000 at a time, $30,000 at a time, then it's interest first. So you actually get to choose on your annuity which taxation method works best for you. So if you need help with that, contact us or your financial advisor to figure out the best strategy to minimize taxes on your annuity.
Okay, so let's talk next about people who own stocks and maybe are paid dividends.
Dividends are taxed at two different ways as well. So ordinary dividends are taxed as ordinary income at the ordinary income tax rates of 0 to 37%. Qualified dividends, which most US-based companies will issue, is taxed at a capital gain. Again, that tax rate could be much lower, 0, 15, or 20% if it's a capital gain because it's a qualified dividend. Again, this is for individual or joint brokerage accounts, not dividends in your IRA or 401k.
Okay. So how would someone know if their dividends are qualified?
When the 1099 comes in January or February, that's when you know. But usually it's US-based corporations who meet certain parameters will have qualified dividends and get you the better tax rate.
So the next investment we want to talk about are Muni Bonds. There are a lot of questions and there's a lot of confusion surrounding taxation on these.
The tax-free Muni Bonds should be a retiree's favorite, right? Tax-free interest. But Amber, it's not always that clear-cut. Let's talk about it. Municipal bonds are bonds issued by governments, local and state governments. There is no federal tax on Muni Bond income, okay? So the interest that they're paying you is tax-free from federal, but not necessarily from state. In order to be, again, we're not going too deep in this, but in order to be tax-free from your state income tax, it has to be issued in that state. But there is one thing to note on the federal level, Amber. If you buy a Muni Bond fund, again, you invest in a mutual fund that invests in Muni Bonds, and you put $1,000 in there, and you sell it later for $1,200, that gain in the bond fund of $200 is subject to capital gains tax. So it's not completely tax-free. And then Amber, you explained earlier, when determining how much tax you have to pay on your Social Security, you have to add in what?
The tax-free interest from Muni Bonds.
Right. So again, the interest might be tax-free, but the interest from the Muni Bonds might be causing your Social Security to be taxed at a higher rate. So I think we'll probably do a future video on just Muni Bonds and how they work. So again, if you have questions on this, feel free to reach out to us.
The next investment we want to talk about are CDs, savings accounts, and money market accounts. Now, these are very common investments.
Right, and they're not paying much interest now, so the tax bill's going to be pretty low. But essentially, just ordinary income, just interest income, just like your ordinary income tax rates. These are not generating much interest for most people now, so it's a little bit less of an issue today.
Okay. The last type of investment income we want to talk about is the savings bond.
Again, several rules here, Amber. So savings bonds, interest is taxed at ordinary income in the year it's redeemed or the year it's matured. Now, if you own HH bonds, you report the interest on those on your tax return every year, and the interest is taxable at ordinary income tax rates. So again, depending on the bond, and there's a couple different ways it can be taxed, but bottom line, ordinary income tax.
So if this all seems a little bit confusing and a little bit much for you and you would like some more information, just go to workwithnewgen.com to schedule a 15-minute consultation and see if we can help you.
There's a lot to know, Amber. It can be overwhelming. We're happy to help if we can. So remember, folks, you can make the rest of your life the best of your life.
Plan now to retire happy.